Hey guys, John Polemy here, Actionable Intelligence. Today is Saturday, May 20th, and this is the weekly market update. As usual, the disclaimer, anything that you hear or see on this podcast or video is not to be taken as investment advice. I'm not a financial advisor. I cannot give you financial advice. Please do your own due diligence. It's your money. It's your responsibility. Okay, so I'm going to put a link to an article by Ben Hunt. He's a guy I follow on Twitter. I don't necessarily agree with everything that he says, especially around politics. But this particular article I thought was it was a really top-notch article, and it kind of really synthesized kind of how I think about the United States and what's happening here. And basically, just a quick synopsis. If you ever had watched the show The Sopranos, there was that episode or that series of episodes where that compulsive gambler guy that owned the sporting goods store got in hock to the mafia, and then they took over his store and basically busted it out. What does that mean? They ran up the credit, they bought a bunch of stuff, they sold the stuff for cash on the street, and they left the business holding the bag, and the guy eventually had to declare bankruptcy. And so what Ben Hunt talks about is, he talks about that, and then he talks about what happened at Bed Bath and Beyond, and then he finishes the article basically how it looks. He makes the argument that the management looted the company over time, and then he segues into the final part of the article, which I thought was the most interesting, when he talks about how basically the policies that we've had in this country over the last 30, 40 years, whatever, have basically just been one series of bust outs after another. What do you mean by busting out? Just basically this combination of people in government that are put in there by various sponsors. And what do? They bust out things to get money for their corporate sponsors. And just a couple snippets from the article. I'll put a link to the article in the show notes, but I thought it was very interesting because it's exactly how I think that, the United States is run now. It's just a big bust out, people feeding on the carcass. It's an empire in decline, and there is no innovation. There's no new thinking. It's just all, a bunch of people feeding on the bones, pecking the meat off, and then we're going to be left with a, hollowed out carcass. So anyways, it says here a couple snippets. It says, in the American context, my personal view is that all of the signature economic policies of the last 30 years, all of them, from NAFTA to the Bush tax cuts, to TARP, to QE 1, 2, 3, Infinity, to Obamacare, to the Tax Cuts and Job Acts of PPP, to the American Rescue Plan, to the Inflation Reduction Act, have been bust-out policies. It's not going to stop because we are increasingly a nation of weak men. Degenerate gambling men, men who in their desperation for wealth or recognition will bet more than they can afford to lose over and over and over again. And I'm not talking about a loss of money, although yes, that too. I'm talking about a loss of autonomy of mind, where the weak man willingly gives away his very identity to a political party or economic creed if they will just allow him to be part of the action. Because in the end, that's all the weak man, the degenerate gambling man, has left, the action. I thought this was a tremendous article. Again, you may not agree. I don't agree with everything that Ben Hunt says politically, but I think he's spot on here. I think he's really written a tremendous article, and I would recommend that you read it. This is exactly, all of these policies. I've seen, how NAFTA has hollowed out the manufacturing of the U.S. When I was working on all of these renewable energy projects in the Midwest, around these small towns, you can see how, I've said this before, you can see how they're hollowed out. You can see that once the manufacturing left, people, it's just a lot of despondency, poverty, lack of hope, drug and alcohol abuse. I mean, it's really sad. And, a small number of people at the top in government, politicians, and people that sponsored them benefited. And of course, not many people, most people aren't going to agree with me on that, but all of these things, the same thing. It's like the Obamacare. It's just an insurance company stop. Look at the stock prices of the insurance companies after that. Okay. I mean, look at who the biggest lobbyists are to Congress, some of the biggest lobbyists, right? The pharmaceutical company, medical insurance companies, and people, the military industrial complex people, and people just are willfully don't want to seem to connect that if you give politicians money, they do what you want them to do. Okay, that's why they're there. That's why these people go there and stay there for decades, and they leave very, very wealthy. On $174,000 a year salary, they're becoming multi-millionaires. Okay, and that's what I think the American people, for a large part, I call them stupid, and that's not for me being arrogant or trying to be provocative. I define the word stupid as the inability to see cause and effect. You can't seem to attach the fact that the people that you're putting in there are causing your demise, and you don't seem to be able to connect that, or a lot of people can't. But maybe I'm wrong. Maybe I'm the one that's like I said, out at midnight in the field, naked, howling at the moon, and I'm the nut job. But anyway, I thought I'd point this out as a great article. This is another good article that I would take a look at, because I'm starting to see now. I listen to lots of podcasts and interviews with a lot of smart people. And what I'm starting to notice now, just like over the last month or so, because of the concentration in the NASDAQ with a lot of the tech companies, some really smart people are starting to come out and say, well, the bear market's over. It ended. It's time to get back in these stocks. And one of the reasons that several of the commenters made was around AI. AI is the new hype engine for the stock market. And we've seen this before, right? It's evident to me that AI will obviously have an effect on the economy. It's an emerging technology. It has the potential to be very disruptive, but is it going to save the market in this over the next 6 months or a year? I don't know. We've heard this before, right? With various other hype, new technologies that were hyped up that were going to be the next new thing. So the reason I put this on here, this is a pretty good article too. I'll link to it, just to keep that in mind when you start hearing these things, right? We've heard this before. Don't get sucked into the hype. It's very, the guy in this article goes through in depth, how the technologies usually develop and percolate through the economy. And, if you're a retail investor and you're out there saying, well, I'm going to buy NVIDIA at 50 times revenue or whatever it's selling at now because it has the most highest processors and AIs. I mean, these are probably not views that are going to lead to a good outcome. Okay. So I guess the bottom line is, from my perspective, you really can't quantify the effect right now or the impact that AI will have on the economy. It will have some impact and effect. I don't think it can be quantified. It certainly isn't actionable to specific investments at this particular time for the retail investor. As far as investing into emerging technologies, or if you're a high net worth person, that you can invest in companies that already are doing business or doing technological advancement in this field, yeah, those are opportunities, but not for the majority of people that are listening to this video or podcast. And so I'll read a couple snippets from this article. When I look around the business landscape right now, most notably on my LinkedIn feed, I feel like I'm watching a movie I've seen many times before. A few weeks ago, I wrote about how generative AI is poised to cause rapid changes to many aspects of how we work and live over the next few months and years. Given AI's potential, it's not surprising to see it talked about constantly in the news and across social media, to the point that it often feels like the only topic of conversation. Here's the punchline here as far as I'm concerned. As is common with many technological advancements, the genuine excitement for something new often attracts a group of vocal maximalists. These individuals display excessive enthusiasm, audacious predictions, and hyperbolic language, as well as massive Twitter threads, insisting that the new technology will revolutionize the world immediately and will become the ultimate solution for all facets of life. That kind of is what I'm seeing also. And it kind of bothers me, right? Because it's like, again, haven't we seen this movie before? 3D printing, Web 3.0, cryptocurrencies, the internet itself back in, 1998, 99, and 2000. We always have, and these things all have made impacts. They all are going to have, impacts at some point. But again, you get this maximalist attitude where it's going to be the end all be all, the best thing since sliced bread. And then it starts veering into, well, what can I do to take advantage of that vis-a-vis investing or speculating? And that's where you have to be careful, right? Because that's one of the justifications that was used for the excessive concentration by one commenter that I listened to, or one podcast I listened to this week, of a guy that, is a pretty big portfolio manager and is saying, well, the bear market's over because of AI and the effect it's going to have. Well, I wouldn't say that, but that's not, it's just buyer beware, caveat emptor. And look at what's the incentive. Why is that person taking this tack? Are they talking their own book? Do they run one of these companies? You always have to look at that also, right? What is motivating this person to take this particular position? Because whether we like it or not, we all have biases. Okay, so let's get into some of the economic news for this week that I think is relevant. Again, this is off the Frank Talks, U.S. Global Investors weekly email. Love their charts. But anyways, household debt now is at a record. It says total U.S. household debt at a record $17 trillion. You can see how it's broke down. Mortgage debt, non-mortgage debt. You see the Fed funds rate imposed on this. Why do I put that there? Well, with the record household debt, if we have a consumer-based economy, and as I have said, that it looks like, based on my nowcasting formula that I'm developing, have, housing and manufacturing are certainly in recessions. Layoffs are happening there. But the single thing that I think that people are hanging their hat on for the economy or for their optimism is employment. And employment really hasn't broken down yet. It's kind of in the yellow. We've had, ups and downs, canceling each other out. We don't have a definitive trend really. But if unemployment starts rising and we already have a record household debt situation, how is that beneficial to the economy? People are going to have to retrench, and they're already, it appears, going into debt to spend, and that's not, good. And the reason why is you have average credit card rates are the highest ever, at least for the last 20 years that this chart shows. It's a 20-year period. The average credit card interest rate is 21%. Now, I've seen credit cards. I mean, I use credit cards so I can get miles. I use it for all my spending pretty much, but I pay them off at the end of the month. I don't incur any interest charges because I pay, like I said, you pay it off at the end of the month. I get the airline miles. I use those to get upgrades and things like that. But, a lot of people, as one person, kind of jokingly says sometimes when we're talking about the consumer, is, a lot of people are just using credit cards for their everyday spending, but they're not paying it off. And so this person said that, these people don't even own the underwear they're wearing. So, because they're paying the minimums, or they're not paying off their balances. And so they're incurring these high interest rates. And so, if you have a Chase card or JP Morgan or Citibank card or whatever, and you're not paying it off and you're having these high interest rates, JP Morgan's taking that money and they're not paying any interest on it, very little, 0.1% or something, and then they're loaning it out to the bleacher bums and shoe clerks at 21%. And it's just not sustainable. Something that I learned a long time ago when I was younger, I got myself in a little bit of debt and got myself out of as quickly as possible. You don't want to be in debt. It restricts and retards your flexibility to do things. And a lot of people will say, well, you don't understand, look, I'm not going to get into each individual. I've had these arguments with people before telling me how much they're in debt, and can I give them some advice, and they're standing there with a brand new iPhone and a Starbucks in their other hand. I mean, you have to look at your lifestyle. If you have to go on chicken thighs and beans for a couple of years to pay off your debt, which is what I did. I lived very frugally for a couple of years, paid off everything, and built myself a bankroll. That's what you have to do. Okay. That's what's required. And I'm not going to get into that, but if you want to build wealth, if you want to, and again, you don't want to waste your time making minimum payments and falling further and further behind. That's the trap that a lot of people get into, especially younger people. They get these cards, they want instant gratification. They don't have the money for the instant gratification, so they run up the credit card debt, and then they're stuck in debt now. And then it's really hard to get out of it, right? Sacrifices have to be made. Why not, never minimize your debt or manage your debt properly? But again, these are not skill sets that are taught. They're not taught deliberately, in my view. It's not like a grand conspiracy, but they don't teach personal finance anymore. Okay. They don't tell people about these things. And so if you're not educated on this, if you don't have parents that are financially literate, if you don't have somebody in your life that's financially literate giving you school on this, then you're sunk. And then you're wasting time. Your most valuable asset is ticking by while you're, up to your neck in quicksand with no idea how to get out of it. Excuse me. The other thing is that this doesn't bode well for, future of the U.S. economy in the near term, medium term. People's ability to go into further debt to make consumer purchases is going to be, stressed because they're already have a maximum amount of debt with high credit card rates. Excuse me. So again, I've talked about this before. It appears that we may be, some analysts and people are saying, well, we're in this bifurcated economy. Yes, housing and manufacturing are both in recession, but we have the consumer economy and employment's still high. But I don't see, obviously I've said before, manufacturing is not the same component of the economy that it was 30 or 40 years ago, but it's still about 15%. And we know how much housing is inculcated in the economy. And so this stuff matters, because if people start getting laid off because demand's going down, which it is, then we're going to have a problem, right? And what I like, again, pattern recognition. Says Philly Fed index below -25 accurately predicted a recession since the 1970s. We're already at -31. So I think everybody is now coming around again, still on the, well, we may have a recession, but if we do, it'll be a soft landing. Again, I'm not sure that's going to be the case. I can't make predictions. Making predictions about the future is difficult. But what I can tell you is that I don't see, and the other thing people are making the argument is, well, the markets are forward looking. They look out a year, 18 months, something like that. And I agree with that. But if most of the sentiment is still for a soft landing or a no landing, then what are they looking at? Okay. To me, all of this data is showing that many parts of the economy are already in recession, and it's going to get worse. Again, remember, employment, which is what the Fed's focusing on, which a lot of people that are hanging their hats on for their investment themes is based on employment, and employment's a lagging indicator. Okay. It doesn't typically start rising until, we're definitely in the recession. And it comes on all of a sudden. People start throwing in the towel, and then it starts snowballing, and again, don't forget about the lag of the previous tightenings that have taken place. They're still working their way through the economy. So I'm going to continue to put these things up. Again, it's pattern recognition. I mean, at some point, once you go into the recession, the Fed will reverse course and begin a reliquefaction process, which will inevitably lead, to asset prices rising. It's just timing that. Do you want to do that now? I mean, housing stocks a lot of them are trading at an all-time high. Housing is kind of in my now casting thing is kind of like in the yellow, because if you look at the 10-year Treasury, it's substantially lower than the Fed funds rate because it is looking out. It's looking at the bond market's looking at a recession, and so it's pricing that in. It's pricing in the fact that rates are going to come down, and so when these 10-year rates started coming down, it lowered mortgage rates, and that there is pent-up demand out there. There is family formation. I'm a big believer in demographics. Now, I've said that before, and other people have come at me and said, no, there's plenty of houses. Yeah, but where are the houses? Where do people want to live? That's the point. People are moving away from places that are not the best place to live to other places that are better in their mind, lower taxes, lower regulation, not a lot of goofy regulations, and there isn't a supply of houses there. So again, yes, if you look at things overall, you may be able to make the argument that there's plenty of houses, but where do people actually want to live? Now, like I said before, there's plenty of houses in Detroit, but nobody wants to live there. So I found this article interesting. It's from the Hoover Institute, which is at Stanford University. It's an article. It's kind of provocative. It doesn't mean San Francisco real estate, all of it's down 75%, but you'll see from the snippets from the article. But this is what we're going to see, right? This is a perfect example. It says the former Union Bank building in the heart of San Francisco's financial district, located at 350 California Street, was auctioned off last week. The winning bid was $65 million, roughly 75% less on a per square foot basis than the comparable building sales from just before the pandemic. This is devastating news for San Francisco because it provides a new market rate benchmark for pricing other downtown commercial building listings, and such a low price indicates that investors have an extremely negative outlook for the future of San Francisco's downtown area. The glut of downtown office space, combined with San Francisco's high housing costs, has led many to envision converting downtown commercial spaces into residential buildings, but not one residential development firm bid on this property. And the article goes into why. And again, people tap dance around the issue. No one wants to live in a dump. No one wants to live in a dump. Nobody wants to be, spending big money to live downtown where all the cool amenities are and the great restaurants and the museums and the plays and the concerts. Nobody wants to live there if you have to step over fentanyl bums and dookie on the street. Nobody's going to do that. And then having crime being rampant. Where are you supposed to go get like aspirin if all of the drugstores close down because people don't enforce, the city won't enforce shoplifting laws? So you have retail shutting down. This is how you spiral down into, with bad policies, creating a dump. Now, certainly the pandemic response and people working from home and these type of things, and some of the tech companies, a lot of the tech companies struggling, this has had a lot to do with it also. But the policies there are exacerbating an already, fundamental issue. Okay. And so as this thing starts spiraling down, more and more amenities go away. It becomes dumpier and dumpier. And this is what you're going to see. And this is what people don't understand about real estate and what's called comps. If you're going to come in there and say, well, I'm going to be an investor and I'm going to buy low, because there's always somebody that's going to say, well, I can rationalize this, or if it's low enough, I'll buy it. But then you're going to say there's a building a couple blocks over that comes up for sale, and they're offering, they're asking this high amount. You're going to say, well, wait a minute. The last building that sold was 2 streets over, the Union Bank building, on a per square foot basis. I'm not paying. Why would I pay more than what was paid over there? And so, and then the idea, what I found humorous was the discussion of converting this stuff to retail. Well, in the city, San Francisco, if I want to convert a building to residential, there's certain laws that like 23% of the units have to be low income or mid income, and you're not going to get people paying millions of dollars to live in downtown and refurbished apartments on the upper floors, and having welfare bums and Section 8 fentanyl addicts living in the building. I'm sorry, but that's reality. And who wants that? You know, hanging around, selling drugs, and all the other pathologies that go along with, you know, these types of lifestyles. That's just reality. And I find it humorous because these cities don't see the conundrum they're in, and they're not going to change their policies. They're never going to change their policies. Look at Baltimore, Detroit. Look at all these cities in the Midwest and in these former great cities. They're dumps, and the people that are there keep, you know, putting the same people with the same failed policies and the same ideas because they're stupid. They can't connect cause and effect. And so, but people do vote with their money. You can believe that. People, when it comes to money, it seems like people are very rational. Nobody's going to invest in or live in a dump or be stepping over fentanyl addicts and dookie on the street. I'm sorry. And so I find this kind of, it's sad. It's sad that, you know, this is part of the decline that I talk about in the United States. This is not just, you know, specific to San Francisco. This is a lot of your major cities in these blue states. This is what the people want. They think that this is good. They think that this is, what do you call it? You know, enabling dope fiends and dookie on the street and all these pathologies. They think that that is being a good person. You know, we're not violating these people's rights. We're being nice. You know, you look up the etymology of the word nice. I think you'll be shocked of what you find. The bottom line is you have to have order. You have to have order. You have to have, you know, there's these things, these problems can still be dealt with, but, you know, the policies that are working or that they're enabling or using or doing, they don't work. They're not working. So why would you continue? So people just pick up and leave. They're not going to live there. So then they come to Austin or Nashville or these places. And of course, the stupidity of their politics in their head, you know, they bring that mentality to that city then. You know, and eventually, folks, you're going to run out of places to run to. And so eventually somebody's going to have to do something. Somebody's going to have to say, that's enough. We're going to have to fix this. We're going to have to use, you know, tough love. We're going to have to, you know, establish order from chaos, or these places are just going to continue to degenerate into dumps. That's all. So again, I put this danger, Will Robinson. This was the headline. This is the cover of Barron's this week. Again, the magazine covers are not 100% predictive, but I just put this up here as a cautionary thing. It says not dead yet. It's talking about oil, and it says down here in the corner, oil prices are down, but not for long. Our roundtable experts find 10 ways to play a rebound. So keep that in mind. You know, I talked about this last week. Price action has been weak for a while. Bear market, you know, as supply has been higher than demand, and with the recessionary sentiment and negative sentiment, you know, is it possible that oil prices could go lower? Very possible. Yeah, I don't like seeing this type of, you know, discussion, but I would say that overall sentiment in the market is negative towards energy. And remember, folks, we had two back-to-back years, 21 and 22, of good returns in the energy market. It's not typical to have, you know, if you look at sector rotation, if you look at how sectors perform year to year, what typically performed well in one year doesn't typically perform well the subsequent year as a top performer. So you have these variances. Again, cyclical movements within a secular long-term bull market. That's what we talk about. But I just thought this was amusing. Keep this in mind, please. May 22nd, 2023. Oil is not dead yet. So we'll see. I didn't read the article. I don't take Barron's, so I don't know. But I did find this interesting. So let's get into some other data. This is from March data. It says global oil demand climbs to a record high in March. Here's some of the, this is the joint data gathering around oil. I don't know who the organization is, but anyways, I'll put a link to the place where I get the data, and you can look at it yourself. The next report, I think, comes out in June, and it will be covering April, the month of April. So it's kind of like lags by a month. says global oil demand rose by 3 million barrels a month, month on month in March, to the highest level ever recorded by JODI reporting countries, driven by growth in China and the US. China's total product demand increased by 1.6 million barrels a day, month on month, to 16.79 million barrels per day, the third highest ever level reported for the country. And this is interesting, right? Because another thing you can look at is, you might have noticed, like, if you follow the traffic stuff in China, it collapsed this week. Road traffic in certain cities, like 40%, I think. I can't remember which city it was. Remember, China does do rolling lockdowns. They haven't locked everything down, but if they have like influenza or COVID outbreaks, they do still tell people to stay home, okay, for short periods of time. So that's what some things that some people forget. They haven't locked the entire country down, but specific cities, and they've always done that. That was even before the pandemic with COVID. They would do that during influenza season too. So keep that in mind. The airline data is doing very well. It's right back to pre-pandemic levels in China and climbing in other countries now. We're coming up on the summer travel season. Maybe this is going to be the last hurrah for the U.S. consumer as they shoot their wad for this summer vacationing. It doesn't look like employment is imploding before the summer. Memorial Day is coming up, I think, next week? And that's typically the kickoff for the summer driving season, the vacation season, and we'll see. So right now, the data is showing that, demand hasn't really fallen off. And so I thought that was interesting. It says global inventories of refined products fell by 39 million barrels in March, while crude inventories declined by 0.7 million barrels. Total crude and product inventories remain 336 million barrels below the 5-year average. So, and again, I think we're closer to the end of the tightening cycle worldwide. I track that as part of one of the tools in my toolbox of my nowcasting formula. And it looks like, we haven't turned the corner yet. We still have tightening going on. But if you look at other folks that track global liquidity, we look like we may have bottomed and have now turned up for the next cycle. So keep these things in mind. Here's global oil inventories from Platts. This is a change in global petroleum inventories, 4-week moving average. You can see that since the start of the year, we've been coming down. We're basically drawing down inventories. That's why I think, the oil price is kind of bottomed around here. I'm not making predictions, but this is what we're seeing, right? You see it's all over the place, but this is what we've seen since the start of the year. And we've also, incorporated also the OPEC cuts, which I'll show in a minute, other things which are happening, right? And the reduction in U.S. production has been off slightly. So supply is not like charging ahead. We see this here. So Seaborne Net Exports since around May 1st. This is when the OPEC cuts came into effect. And these are the total liquid seaborne net exports from Saudi, UAE, Kuwait, Iraq, Algeria, and Gabon. And you can see that since May 1st, they've been in a downtrend, okay? And so this is your daily exports of seaborne exports from these countries. So millions of barrels a day, and we're going down. So that's why you're seeing the tightening in supply and the drawdown in inventories. And so we'll see if as this continues through the summer, as we expect, the travel season to ramp up in the Northern Hemisphere, the return of, air travel in China, growth in air travel in India, oil demand relentlessly increasing. We'll see if we do, in fact, get the higher prices that many were talking about in the second half of 2023. This is from the IEA. This is their monthly oil market report. And so this is what the IEA is inspecting, in the second half, millions of barrels a day deficit from, Q3 and Q4, where you have supply basically slightly below 102 million barrels a day and demand, heading for 104 million barrels a day. You can see why we have been weak this year. We have been slightly we have been oversupplied. We talked about, the Russians pushing crude into the market before sanctions. We talked about the seaborne, Iran dumping all their seaborne storage. The SPR releases were still happening to this point, and so that's all reversing, and we're actually going to see the demand now starting to increase as we go into the latter half of the year, at least the IEA's estimate. So keep that in mind when you're in a deficit situation. It doesn't take that much of a deficit to cause a move in prices. And with sentiment being extremely negative in the oil market because of the amount of discussion around recession, this could be a contrarian setup. So this was a Bank of America Metals and Mining conference that happened, I think, in the last week or so. This is a slide. This is a Cameco's information. Bank of America kind of put this together in one slide. I'll put a link to the discussion that Grant Isaac gave from Cameco at this conference. I haven't listened to it yet, but I'll include the link to it. You have to register with your email, I think, and then you can listen to it. But I think this is like the one slide that you need to see just to kind of like explain why we're in a bull market in uranium. And if you look at demand over here, in the near term, you have reversal of early retirement, closures of reactors, new markets. Medium term, clean, secure, energy-focused reactor life extensions. And the long-term reactor new build growth, development of small, modular, and micro reactors. You have security of supply concerns from Russia. You know that legislation, I think, is moving through the U.S. Congress to ban the importation of Russian uranium products. You can see, though, that their fuel cycle, this is worldwide, they supply 14% of the uranium, 27% of conversion, and 39% of the enrichment. So you have strong uranium conversion and enrichment prices due to heightened security of supply concerns exacerbated by ongoing geopolitical concerns. And so you see prices increase across the fuel cycle. Here showing from January 20th or 2020 to January 23. You have a 63% increase in the term price of uranium and 105% increase in the spot price. And you have people wondering if we're still in a uranium bull market. Yes. Again, sediment and liquidity is what's holding back a lot of these junior miners. Again, those are speculations. If you look at Cameco and Kazatomprom, companies that are actually mining the metal, they're doing fairly well. I don't think you're going to see a bull market in these juniors, penny dreadfuls, trading sardines, crapkos, whatever you want to call them, until we have a change in liquidity, and then the liquidity starts coming back to the market to get the speculative juices flowing again, okay? And maybe we need a catalyst like a big takeover or something like that, or some consolidation to get going to bring attention to this market. Because right now, it's just a slow grind higher in this bull market and the fundamentals. And, right now, sentiment in the market is terrible in a lot of junior mining just because the liquidity is not there. When you have these tightening liquidity, that's the main fuel. Liquidity is the main fuel for these speculative type situations, and that's what the majority of these uranium stocks are. But I think that you cannot make the argument that we're in a tremendous bull market. That argument can't be made. The fundamentals are there, and again, we still have quite a few people that don't seem to understand that just because the fundamentals of the business are good, if you're not in the right part of the cycle, that doesn't mean your stocks are going to go up. I mean, that's too simplistic of thinking. That's not how things work. Again, if you look at the history of junior mining, whether it's uranium mining, whatever it is, gold mining, these things kind of just go along crappy, and then they catch a bid and they go on a run. and they go on a tremendous run, but it's usually in the context of sentiment, bullish sentiment, starts building, some catalyst kicks it off, and then you have all that liquidity pouring in, right? Speculative juices start flowing, and it starts creating this flywheel effect, and we need something to get that going in the juniors. But we do need to see more we need to see the liquidity cycle turn first. Here's more bullish news. Global nuclear capacity must triple by 2050. Global nuclear capacity must triple by 2050 if the world wants to hit green goals, says Wood Mackenzie. Lower costs are key to boosting nuclear. They say, quote, for nuclear power to flourish, governments, developers, and investors must work together to establish a new ecosystem. So this is what happens. Here's your base case. Here's your current generation capacity and gigawatts. This is the base case, which is pretty much like a doubling, if you will. And then here's, if the pledges best case scenario turns out, where you end up. So it would have to triple by 2050. So again, I think that after we get through this current infatuation with rebuildables, which we will, I mean, it's going to prove that it's not going to solve the problem eventually after hundreds of billions of dollars or trillions of dollars have been spent. And then I think the last man standing will be nuclear. But we'll see, right? That's kind of how I think this develops over the next decade. And so I talked about this before. I was re-listening to somebody put it on the Discord for the Actionable Intelligence Alert newsletter. We have a Discord there. If you're a subscriber, you can participate. And I had forgotten this interview I had done with Trader Ferg. Maybe it was a few months ago, but somebody posted it, I guess, because Crux Investor posted it. And I had talked about, one of the things that Ferg and I talked about was the peak ESG. This is one of the things that I've been tracking, because I think we have reached it. It doesn't mean it all of a sudden just disappears, but I think that they had their time in the sun. And then again, when it comes to financial instruments, investing, speculating, the bottom line is always the bottom line. I don't care what anybody says. You can throw all the niceties out the window. If you're running a pension fund, if you're running an investment fund, a family office, and you think that, well, I'm going to invest in renewables because ESG and it makes sense and yada, 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 whatever your bias is, in the end, if the returns are subpar, you're not going to stay invested there. You can't, because you have obligations, you have things that your foundation, your pension fund, your endowment, whatever you're running is there to support. And if you're not hitting the returns, then you got to move on. And I think we've seen that. Not only that, people are just tired of the bull crap and the nonsense and the wokeism. And I think the overall, as the political and social pendulum swings back the other way, which I believe it's starting to do, starting to crystallize and swing back the other way, there's not going to be an appetite. I mean, again, this won't fully disappear, because there's always going to be true believers. There's always going to be governments, I think, especially in the West, pushing this narrative to some extent. But I think we've hit the peak, and it's in decline. And so here's an article from Reuters. It says, at least this is in the UK, interest in ESG investing has waned among UK investors, with less than half now prioritizing ESG investments over maximizing returns. Imagine that. I mean, we have been talking like that here on the podcast and the videos for years. Okay. In the end, the bottom line's the bottom line. So that's what people actually care about. I mean, let's cut the crap. According to a survey of 1,000 UK investors by Charles Schwab UK, they found that since 2021, the number of investors who consider ESG when making new investments has fallen from 44% to 38%. So you see, it doesn't just collapse, but it's eroding, right? Meanwhile, the number of investors prioritizing sustainable investing over maximizing returns dropped to less than half, falling from 55% to 47%. Overall, the number of investors who believe companies with strong ESG credentials are attractive investment options has dropped from 75% to 68%. And so what I have found, as just being an observer of social trends and investment trends and themes, is that as you go through time, we have the zeitgeist changes among the population, or the government pushes a certain narrative, things ebb and flow, whatever. And, things that come into fashion then go out of fashion, whether it's short skirts, long skirts, what have you. And it's the same thing with this investing. These themes come along. Again, we just talked about it in an earlier slide, like AI is the new, best thing since sliced bread. ESG was going to be the thing. Now it's going to, the issue with ESG is it's being pushed by governments, and governments have a monopoly on violence, so they can pass legislation. They can say you have to have a certain amount of composition on your board, for example, or you have to, with carbon credits or what have you. They can force these things. But if people are left with their choice, they're going to go to where the maximum value or the best returns are. That's just human nature. People are going to do what benefits them the max if given the choice. So here's Toyota. Toyota's never really bought into the battery electric vehicle situation. They've always had the hybrids, where it's electric, but it has that gas engine, so that if you can't charge or whatever, the gas engine kicks in, and like the Prius and things like that is my understanding. I haven't done a lot of investigation, but that's kind of what they've been on. And their argument is, well, this gives more flexibility to consumers. They don't have to worry about charging anxiety and things like that, notwithstanding the fact that the battery metals don't exist. Toyota has been saying that for a while too. Now, they may be talking their book, they may be talking their product line, but I would say that they're worth listening to, because Toyota is probably one of the most successful, if not most successful, automobile manufacturing companies in the world. And so I think it's relevant what they say. Again, I'll try to put links to some of these articles if I can. Some of them are paywalled, so if they're paywalled, I don't bother putting I get these from people send me these articles and emails and stuff, so I just post them here where I can to take the snippets. But you can look this stuff up if I don't have a link. So here's Toyota. In the article it said a lack of resources means battery electric vehicles cannot be the auto sector's only answer to climate change. Toyota Motor Corp's top scientist said Thursday, warning that focusing on BEVs could lead some drivers to hold on to polluting vehicles. Quote, battery metals and renewable charging infrastructure will eventually be plentiful, unquote. Then he goes on, this is a guy that's the lead technologist or whatever at Toyota. Then he goes on to say, but it's going to take decades for battery material mines, renewable power generation, transmission lines, and seasonal energy storage facilities to scale up. Well, they're never going to. I mean, he's not going to say that, because that will just invite a lot of incoming fire. They're not going to scale up. It's simply not going to happen. You can see from the political decisions that are made. If you're going to make energy policy not on free market principles, but on government policy by the likes of Jennifer Granholm and certain invested politicians that are, working for, groups in the rebuildable industry. So you have all these rebuildable generation going in, but no, not insufficient transmission and generation, right? And so that's a problem. You talk about we've talked about battery metal supply and things like that, or just copper and things like that. They simply they're not going to exist in the quantities that are necessary in order to accomplish if you try to go fully renewable. Notwithstanding the fact that Western governments are going to try, and that's why we have the mantra of heads we win, tails you win more. But Toyota gets it, I think. A lot of people would say, well, they're just talking their book because they don't make battery electric vehicles. They make the hybrids. Well, you can ascribe any motive you'd like to it, but I like to take in different, views and consider them. I think this is the correct view. And so, again, it's just going to lead to more opportunity for us because of the lack of investment, the lack of available metal, actually. I get on a lot of calls and listen to a lot of people talk about this, and a lot of mining executives don't know where all this new metal is going to come from. And exploration budgets really haven't went nuts yet. Now, I think if, say copper went to 10 or 12 or $15 a pound, yes, I think there'd be a gold rush and everybody would be out there looking for it. But how much, where are the big, juicy copper mines going to be found? And if you do find one, how long is it going to take you to bring it into production? And where's it going to be? In the middle of the Congo somewhere? I mean, that doesn't mean it can't be done, but that's a whole nother set of problems, right? And then if you have to take geopolitical concerns into account, where you're going to limit yourself of importing things from certain countries because you don't agree with them politically or whatever, then that further limits, what you can do. And if you're going to take the tack the United States has of not allowing development in your own country to supply these metals, then you just, again, you're being stupid. You're not looking at cause and effect. I want to accomplish this goal of renewables and transition, energy transition, which requires a huge amount of investment in mining, but yet mining is bad, and therefore I'm going to limit the mining, and then I'm going to cut myself off from a large portion of the world that can supply me with this stuff. And so how does that goal get met? It doesn't. It's just a bunch of nonsense that's just not going to happen. What is going to happen is a lot of slops, like we talked with the Ben Hunt article, the busting out of the economy with these legislations, IRA and stuff like that. There's all these tens of billions, hundreds of billions of dollars in incentives and SOPs to industry. And as long as that's the real goal, right? Make sure that your political donors and sponsors get paid, not really solve any problems. Because if we really wanted to solve the problems, like I said, we build 25 nuclear power plants in the next 5 years. We'd have a industry government symposium, sit down, hash out a standard for reactors building, mandate that the stuff has to be built here, have the government step up and give guarantees around insurance and things like that, common design, and then go for it. And we would create a ton of jobs and accomplish a lot. 25,000 megawatts of new nuclear in the next 5 to 10 years in the U.S., would be substantial. That's STEM jobs, high-paying construction, high-paying manufacturing, the whole shebang, engineering. But nobody's interested in really solving the problem, just creating SOPs and busting out the U.S. economy. That's a soapbox for this week. And so it's going to, again, we've talked about this in the past. This is the kind of thing that's going to make it more difficult to reach these goals because I don't know the full context of this new Chilean mining law, but I do know that if you disincentivize an activity by raising taxes on it, you're going to get less of that activity. And so it remains to be seen. So it says Chilean lawmakers have approved an amended mining royalty bill in the works for almost 2 years, which will require companies operating in the country pay more taxes and royalties to the government. The bill, endorsed by the Senate last week, was approved by a vote of 101 in favor to 24 against. It now requires only the signature of President Gabriel Boric, who has publicly backed it to become law. It's talking about the Mining Association here, said it described the final legislative language as, quote, better than what was initially proposed, giving credit to Finance Minister Mario Marcel for introducing industry-friendly revisions. So it remains to be seen as to whether this will have a substantial effect on, like I said, causing less investment, causing less desire to develop. Chile is I think still the largest copper producer in the world. So if you're going to have this revolution, I don't think you want to put, I think Peru, them, and are the two largest copper producers, or in the top 2 or 3. But regardless, if you disincentivize something that you want to happen, then you're going to get less of it. If you want more copper and you put roadblocks up to getting more copper, then don't expect to get more copper. And if the demand is increasing, then you're going to have a higher price. So you see how this stuff, why I'm bullish on these things. This is why we watch these type of things. I expect more of this from governments, more resource nationalism, more, especially in the West, more restrictions on resource extraction or more regulation, which raises the cost. and creates hurdles and then requires a higher price for that material to clear those hurdles, and yet still give an incentive to a company to risk capital to bring additional material to market. So anyway, we'll see how this plays out over time. This isn't going to be the last country that does this. I would mention, I didn't put the article up, but I did see an article where I didn't realize this, but Zimbabwe was a country that was like in the top 10 in carbon capture projects. So like, I guess like planting forests, and then you get a certain amount of carbon credits, yada, yada, yada. Well, they just passed legislation there that the country wants to capture half of those credits or the monetary benefit for the country of Zimbabwe. And so that caused a big kerfluffle in the carbon capture market, because people were like, well, if they're going to nationalize it, then, what's the incentive to do this? Again, I mean, what do you expect people to do? If they see these countries are poor, or governments are staffed by sociopaths, you put a pot of money out there and you think you're just going to go there and take the money out of the country. I mean, that's a little naive, I think. So again, you see these things when a pot of money appears in a country with a fixed asset. What are you going to do? You're not going to like uproot all the trees that you planted there and take them somewhere else. You're going to have to get a deal. And there's a company there, like this company I follow for many years there. I've just really been impressed with the management. They're probably one of the best gold mine managers in the world, Caledonia Mining. They've been operating even since the Mugabe days and have constantly been making money. They just got to deal with, again, it goes back to what I've said before, the adult person understands the world they live in and adapts themselves to it as best they can. And sometimes you can make a project work and sometimes you can't. So anyway, that's it for this week. Appreciate, again, the viewership. Things are kind of in the doldrums. We're kind of like, in the Sargasso Sea with no wind, just sitting here, in the hot sun. Nothing's really happening. People are getting bored. Again, sell in May and go away, come back Labor Day. I mean, enjoy the summer. Nothing I think is major going to happen. I think we just are keeping an eye. I'm keeping an eye mostly on these what's happening right now in the economy, not to forecast it, but watching employment. That's the thing that I'm focusing on to see if the economy weakens. This commercial real estate thing, I think, hasn't percolated through all the regional banks yet. And the other thing to keep in mind is, these high Fed funds rate, high interest rates, as the government continues to roll debt. I did see a link. I'll look it up, maybe post it next week, of the interest that the U.S. government's paying on its debt is now approaching, if it hasn't already, passed $1 trillion a year. So, like I said, we're closer to reliquefying than we are continuing this tightening. But I think it's all going to depend on employment and whether or not we have any more landmines go off, like in commercial real estate or corporate debt or things of this nature. Okay, guys, that's it for this week. We'll talk to you next week. Thank you.